We are witnessing history, folks. The federal government came out and declared this is the boldest mortgage reform in decades. Well, I don't know about that, but I'm giving it a different label. I'm calling it It's About Time. And I'll get into that today. Also, take a look at the inflation rate, which came down again this week, and also look at the local GTA stats, all right here, right now on Live at Lunch. Thank you so much for joining me. I'm Lambros Demos on this nice Wednesday afternoon. Again, thanks for joining me. And in case you haven't heard, our deputy prime minister came out and made two major announcements this week that do affect the mortgage industry, affect first-time home buyers, affects all buyers really. It affects the real estate industry, banking industry, the new construction industry. So a lot of people are affected here, and the verdict is still out on whether this is good news or bad news. It might be good news for some people, maybe not so good for others. But we'll see how it plays out. In the short term, these are the highlights. So we have 30-year amortizations are back. Okay, so if you recall, back in June, the government came out and said that we are now extending 30, it just give you some backstory here. Before, amortizations were maxed at 25 years unless you were putting down more than 20%. So less than 20%, it's called an insured mortgage because you need to take out mortgage insurance on it via CMHC or any other mortgage insurer. And over 20% is called uninsured because you don't need that mortgage insurance. So there's more regulations on the insured mortgages, and they were limited to 25 years. So now the government is saying that they're extending that to 30 years, not just for first-time home buyers purchasing a new construction, because that was the original announcement over the summertime, if you recall, which really didn't help anybody because, you know, it was such a limited pool of people that it helped because most new construction requires a 20% down payment anyway. So, you know, it's hard enough for first-time home buyers to cough up 20%, even though it's extended over a period of months and years. But still, once you put down the 20%, you're eligible for 30 years anyway. So it wasn't a benefit at all, really. But now, this week, they came out and changed their position and said 30-year amortizations are now available to all first-time home buyers, regardless of what you're buying. You can buy pre-construction, you can buy new construction, you can buy resale. So that applies to all first-time home buyers. It also applies to anyone buying new construction. So you don't have to be a first-time home buyer in order to get that 30-year amortization for the new construction, which again is kind of like a non-benefit because most new constructions require you to put down 20% anyway. And so for the very limited builders that you can get in with less than 20%, I guess now you can enjoy the benefit of 30-year amortizations. So, and I use that word benefit loosely because we're going to get into the pros and cons of these announcements in a few minutes. I just want to lay it out all for you first, and then by all means you can form your own opinion, and I'd love to hear your opinion. I want to keep this as interactive as possible. So if you agree with what I'm saying, by all means, you can give me a like. If you don't agree, that's fine. You can write a comment here, and I'm happy to discuss that. By all means, I'm also happy to take your questions. So if you do have any questions, by all means, post them here because you never know who else watching has the same questions as you. So don't be shy. Go ahead and post your questions here and your comments and your likes, of course. So getting back to the announcements. So we've got the 30-year amortizations in for all first-time home buyers and all buyers of new construction. this is going to make the builders very happy, by the way, because now there's more people going to be able to qualify. Um, so it's also the other announcement they've made is they are increasing the cap for insured mortgages. So I mentioned the difference between insured mortgages and uninsured mortgages. So previously, anything up to $1 million you could get with an uninsured mortgage, which means less than 20%. And anything over $1 million, you had to put down 20%. So it was in effect uninsured. Now they've increased that cap to 1.5 million. And that's why I said it's about time, because the $1 million, if you live in the GTA, it doesn't buy you very much. The average price of a house in the GTA has been well over $1 million since early 2021. So we're talking about 3.5 years where the average price of a home, any type of home, was over $1 million. So people had to cough up 20% in order to buy an average home. An average detached home was well over 1.5 million. So if you wanted to get something bigger, if you didn't want to settle for a townhouse or a condo, you had to shell out much more than that. But now they're changing it. They're saying up to $1.5 million. You can still put down less than 20%. And the absolute least amount you can put down is somewhere in the 8.33% range, because the way it works for down payments in Canada is the first 500,000, the minimum is 5% down. Anything from 500 and up is 10% down, up until now 1.5 million. So you're looking at the first 500,000, 5% down is $25,000. And then anything above that, so now we've got from 500,000 to 1.5 million, that would be $1 million. So you're looking at 10% of $1 million is $100,000. So you've got $125,000 minimum down payment required now on a purchase of $1.5 million home. Sounds like a lot, but before it would have cost you 20% down. So it would have been $300,000 you'd have to cough up in order to purchase something at the $1.5 million mark. So there is a significant savings there and benefit for people entering the market. If they don't have that kind of down payment, now they can still purchase that. But as I said, it does come with a few some downsides to it, which we'll discuss in a second. Here, I want to give you another example, though, because a lot of people may not, consider buying something at 1.5 million. So if you're buying an average house, which is still at around the $1 million mark, now you're looking at $75,000 versus $200,000. So again, before this week, you had to cough up 20%. So you would have had to bring $200,000 to the table if you want to buy an average home in the GTA. Now you only need to bring $75,000 to the table. Okay, and then you can mortgage out the rest of it. Is that good or bad? Some people will say it's great because it allows for more people to get into the market. So the upside here is more people will qualify to get into the market, and home ownership has its own benefits, right? Obviously, it's a way of building wealth. It allows you to have your own property, roof over your head. You don't have to worry about a landlord increasing the rent on you or kicking you out because they want to move in and you have to keep moving, etc. It allows you to be part of a community, et cetera, et cetera. The list is so long for home ownership. So that's a really big plus for people who can get in. The downside to all this, obviously, is that it's not cheap. Yes, you're going to be saving some money, uh, up front with the 30-year amortizations, because now you're looking at on a okay, so maybe let's take a $650,000 average mortgage in the city of Toronto. So if you extend that from 25 years to 30 years, you're saving about $300 a month, right? Which is not, chump change. So $300 a month can go a long way and allow more people to qualify to get into the market again to purchase something. However, you know, over the long term, you're going to be paying much more interest, right? Because now you're paying interest over 30 years versus 25 years. And granted, the last few years, it's going to be mostly principal that you're paying down, because the way mortgages work here, the front end is more heavily weighted towards interest and less principal. And as you go into the life of the mortgage, that's going to balance out a little bit, and then obviously towards the end of the life of the mortgage, then it's going to be mostly principal that you're paying and less interest. But still, I'm not sure of the exact numbers, but maybe over the first 5 years or so, you're going to be paying at least $10,000, maybe $18,000 more in overall interest. And because we here in Canada, we typically renew mortgages every 5 years. Could be less than 5 years, it could be 10 years, whatever, but the average is about 5 years versus our cousins in the US, which when they take out a 30-year amortization, they have that term and the interest rate for the full 30 years. I don't want to get off topic here, but just that's why I said the 5 years. So typically every 5 years you renew something. And so you're looking at the interest paid over the first 5 years. It's going to be probably the most interest that you're paying for the life of the mortgage. So that now has gone up, even though you're paying less on a monthly basis. The overall interest that you're paying is going to be more. And then when you go to renew it after 5 years, there's going to be a larger principal for you to renew. So it might be a little more challenging to renew at that point in time, because you wouldn't have paid down as much as you would have had you taken on a 25-year amortization, because now that chunk that you're paying is smaller. So you're bringing the principal down much less than you would have previously. So, and again, by all means, if there are any questions out there, I'm happy to take them right now. If you want me to explain something again, by all means, I'm happy to do that. So people are going to be in debt for longer if they do this. Also, you have to consider, with a smaller down payment when you get into the market, you're increasing your vulnerability, right? You're with that higher debt load that you have. If interest rates go up again, or if we're stuck in a situation where something's happening to the economy, home prices fall for whatever reason, or interest rates go up for whatever reason, now you're burdened with a much higher debt load, right? So a lot of people have found themselves in the last couple of years, while interest rates have gone up, that they couldn't afford their mortgage payments anymore and have been forced to sell. Thankfully, it's not the majority of people, but some people have found that our default mortgage number has doubled. And when I say doubled, you have to look at it in context. We've had the lowest default mortgage rate probably out of all the G7 countries. And it's like 0.0001% or so, whatever it is. It's a very low percentage. I think it's like only 10 or 15,000 out of all mortgages in the millions, right? So it's a very, very small amount, but still it has now doubled, right? And the fact that it has doubled shows that a lot of people are entering that default stage of their mortgages. That may increase if you take out a larger mortgage with a smaller down payment. Again, you're increasing your vulnerability there. Should anything happen, interest rates go up again, et cetera, et cetera. Excuse me. It also may tempt people to get in over their heads, right? So if all of a sudden they say, oh, I can qualify now for a $1.5 million mortgage whereas before I was only qualifying for $1.2 million mortgages. They may bite off more than they can chew. They may get in over their heads. So it may tempt people to do that. So I don't know if that's such a good thing for people. If they're getting in over their heads, it's actually not a good thing. You shouldn't do that. Stay within your means, buy within your means. Just because you can do something doesn't mean you should. Okay, so I would always like to keep a buffer before, overextending myself when I'm purchasing anything, right? So just keep that in mind as well. And obviously, long term, this may drive home prices even higher. Now, depending on which side of the fence you're sitting on, this is good news or bad news, right? It's obviously good news for current homeowners, it's good news for sellers, et cetera, if home prices go up. But if you're a buyer, if you're trying to get into the market, may not be such good news, because now it's benefiting people in the short term. What's going to happen if this increases competition? This increases the pool of buyers. Obviously, home prices are going to go up. And then you combine this with interest rates coming down. Again, more people are qualifying to get into the market. It can only drive prices upwards. So that's one thing to consider as well. So speaking of interest rates, I do want to talk about that in a second. But the other big news that came out this week is the inflation rate came down once again. So if you recall, last month had said that the inflation rate was down to 2.5% year over year for July. Now the August numbers have come out, and it's down to 2%, right? So not many people were expecting that. I mean, people were expecting that it would drop month over month, but to fall all the way down to 2% took some people by surprise, including myself. And this is the Bank of Canada's target rate. So they were talking about this 2%. We want to get inflation down 2%, 2%, 2%. Now it's 2%. It's there. And I want to dive a little deeper into that as well. And keep in mind, again, 2% inflation still means that things are going up in price. It doesn't mean things are coming down in price. So don't get it twisted here. We still have inflation. We still have prices going up, but not as much as they were going up before, which is a good thing, obviously. So, and it hasn't been 2% since, again, early in the pandemic. Since about February 2021, we hadn't seen an inflation rate of 2%. It's always been higher than that. So that's good news from that front. And the main thing that brought the inflation down, so the main reason for this deceleration of inflation, was gasoline prices. Go figure, right? And if you've been paying attention to the gas prices, you've seen some come down. Obviously, they've come down a little bit year over year. So that contributed to the overall decrease in inflation month over month. On the flip side of that, the thing still keeping inflation up at 2% is, drumroll please, mortgage interest cost. Okay, so if you've been following me for a while, you know that I've been hammering on this practically every week. Okay, so yes, inflation is not a good thing, it needs to come down. But when you raise interest rates, you're raising the mortgage interest, and you're raising shelter costs, you're raising rent, et cetera, which also drives up inflation. And for the last few months, it's been mortgage interest costs that has been keeping inflation at an elevated space. And Bank of Canada has been trying to bring it down to 2%, or at least between that 1% to 3% range. And it's been mortgage interest that has been preventing that from happening. Because if you remove, and this is important, if you remove mortgage interest cost from the 2% overall inflation, inflation only comes to 1.2%, which is well below the target range of the 2% that the Bank of Canada is always has been preaching, right? So there you have it. The mortgage interest, it's kind of like a self-inflicted wound by driving up these interest prices. These interest rates. You're keeping inflation up. So I guess they've realized that now, and that's why we've had 3 consecutive interest rate cuts one in June of 0.25%, one in July of 0.25%, and one in September of 0.25%. The next interest rate announcement is not until October 23rd. So we're still about 5 weeks or so away from that announcement. And I can almost guarantee you that there's going to be another rate cut on October 23rd. It's probably written in stone by now that there's going to be another rate cut, because we have to look at everything. So the inflation rate is down to 2%, where the Bank of Canada wants it to be. And the largest contributor to higher inflation is mortgage interest. So it only makes sense that we need to cut that in order to keep inflation down. Also, when you look at the unemployment rate, that went up again. So it was at 6.4%. Now it's at 6.6%. And it's been going up consistently since the beginning of the year. So the Bank of Canada also looks at that. So that's gone up. And as well, today, the US is actually going to announce their interest rate decision. And many people are speculating that there will be an interest rate cut south of the border, which is, sometimes Canada is in line with what the US does. So all these things point to another interest rate cut in October. The only question here is, how much of a cut is it going to be? Will it be another 0.25%, or will it be 0.5%, right? I'm kind of leaning towards the 0.5% right now. I think the Bank of Canada is trying to, catch up with what's happening in the economy, and I think they're ready to make, excuse me, I think they're ready to make a larger cut. So I wouldn't be surprised to see a 0.5% rate cut on October the 23rd, right? But I'll keep you posted on that. We'll look at we have another inflation report coming out in October prior to the interest rate announcement. That's going to tell us what happened in September. So a lot will depend on that. Plus another labor report is coming out in October prior to the interest rate announcement. So again, it's too early to say for sure what's going to happen, how much of a cut there's going to be, but there's going to be a cut. 100% there's going to be a cut on October 23rd. All right. That is that. If there are any questions, I'm happy to take them now. Otherwise, I'm going to quickly go through the stats that we've seen in the GTA, briefly comparing the first half of August to the first half of September. So far, what's been happening. And again, not much of anything. If anything, market's still a little slow as to what it was in August. However, we did see a large increase of new listings come out in the city of Toronto, but I think most of those are condos, because I think right now we've got like a record number of condos on the market in the city of Toronto. So there's no surprise there that new listings went up about 50%. As I said, from the first 17 days of August to the first 17 days of September. And I'm not counting today because most transactions happen later in the day. So I'm only looking at the first 17 days of the month. As opposed to Peel Region, where new listings only went up 6%, right? So that kind of tells me that most of these new listings are condos. And then you look at the sales volume. So that has dropped, both in Toronto and in Peel Region, despite inventory going up. Sales volume fell about 11% in Toronto and 15% in Peel Region. So things are still slow, but I don't think they're going to remain this slow. I think we're probably hit the bottom of the market right now, because typically second half of September is when things start to pick up. Summer's done, kids are back in school, most people are back to their routines, so now they can focus on things like buying real estate, etc. So we should see a tick up in the second half of September. And the other thing that's telling me we're going to see a little more activity in the second half of September is there's lots of pent-up demand. And I say that because despite sales volume being down, we did see a large increase in the number of showings and a large increase in the number of offers. Now, obviously, these offers aren't going anywhere. Maybe some tire kickers, etc. But it is telling us that there are still people going out there looking at houses, putting in offers, and eventually these people are going to buy something, you would think, right? So we saw an increase of 21% in showings in Toronto, and an increase of 7% of showings in Peel region, and an increase of 19% of offers in Toronto, and an increase of 4% of offers in Peel region. And then you look at days on market as well, where things are taking about 3 days longer to sell in Toronto, and about 2 days longer or so to sell in Peel region. So that's that in a nutshell. As I said, pent-up demand is still a thing right now, and that's going to get even more because of these interest rate cuts, because of these announcements by the federal government. I wouldn't be surprised to see activity pick up in the second half of September, but also going forward into the winter time, because these policy changes aren't expected to take place until December the 15th, and there's not much activity around Christmas time. So we may see a very active January again, which we saw during the pandemic. January tended to be a very hot month in real estate, both in 2021 and 2022 as well. So don't be surprised to see another very active January in 2025. So that's my other bold prediction. All right. And prices aren't really falling. I don't look at prices halfway through the month. I'll have a better idea of prices at the end of the month. But from what I can tell, and the pent-up demand, even though these people are putting in lowball offers, sellers aren't capitulating. They're staying firm. They're staying stubborn, and prices aren't going anywhere. If anything, prices will probably go up with these policy changes, with these lower interest rates. You may see prices go up over the next 12 months or so. And that's that. Thanks again, everyone, for joining me. I don't see any questions here, so have a wonderful afternoon.